Hey, welcome investors to the 40 Finance channel. It's time to check on our FAANG stock favorites here in the midst of all this destruction we're seeing in the stock market. And the goal here is pretty simple. We're going to use all forward-facing metrics. We're going to look at where the forward estimates are trending in terms of revenue and earnings. And then we'll compare that to historical forward valuation trends for each of these stocks. So let's jump right in and kick things off with Apple. All right, clicking over here to SeekingAlpha to check in on Apple stock. As always, as we go through some of these SeekingAlpha tools and features, if you're interested in learning more, my affiliate link is in the description. You get a free trial as well as 50% off a year subscription to SeekingAlpha Premium, so please check that out, potentially support the channel. Now, as far as today goes, we are here on June 13th. Apple's trading at 133, actually down 2.5%. If we look at last quarter's earnings, we'll do one quick rear view mirror check, and that was on April 28th. They beat on EPS, and they beat on revenue. So the last quarter that Apple came out, they hit all of their benchmarks. Now, looking ahead to the next quarter, at least as it's estimated today, you've got $1.15 as the gap estimate, and you've got revenue at $82 billion. And you see here in SeekingAlpha, they do the revisions trends over the last 90 days. You only have 3 analysts who have increased their estimate, but you have 25 who have lowered it. Now, obviously, that doesn't look very positive, but let's dig into the meat of these revisions. And let's scroll right down here to the table view. So this $1.15 estimate that we saw on the previous page, that would actually be minus 11% year over year. And as far as the trend goes, past 30 days, not too much damage, only minus 0.48%. But over the last 3 months, it's come down minus 7.4%. But if you scroll out a little bit and get into the 6-month trend, it's only down 2.5%. Now that's just for next quarter. And of course, we do mostly long-term investing on this channel. And if we just eyeball the future going out several quarters, I would say that the trend, although negative, isn't too ridiculous. You get past the next quarter, and then you're looking at a couple minus 2s and 3s, potentially even a positive for fiscal quarter 2023. How about on the revenue side, though? Will people stop buying Apple products, right, in the wake of all this recession talk? Well, for the upcoming quarter, we've got an $82 billion revenue estimate. That is about 1.5% year-over-year growth. And then you have the trend, which is basically flat over 1 month. 3 months, you're down 4%. And 6 months, again, scrolling out a little bit, you're right here at flat. Okay, so that's a quarterly view. Let's take a look at how this sets up on an annual view. And with that, we get a better idea of annual growth, which, in the long-term world is much more important than quarterly growth. But as far as September 2022, that's when their fiscal year ends. They run on a slightly different calendar. The total EPS estimate right now, the consensus, is $6.15 on the EPS. That would actually be 10% year-over-year growth. And if that were to be put on the board today, at the current price, you would have a forward PE of 22.31. So let's take this 22.31 and see how that stacks up historically for Apple stock. All right, now the best place to do this, in my opinion, is over at Yahoo Finance when it comes to looking at historical valuation stats. They have some of the best in the business. This is a premium feature here. So let's go to forward PE, right? We were at about 22.31 as of today. SeekingAlpha updates more frequently than Yahoo. They have it at 22.57. So we're going to have to go back pre-COVID, right? Because we know that the entire stock market landscape has changed. So let's look back at 2019 and before. You had forward PE numbers back then of about 17, 14, 13, 11, and 13. You could make the argument that although Apple has come down, there still could be room for this multiple to come down even more. Now, the catch here with Apple is, of course, they have a long history of share buyback programs, right? But even the largest share buyback program is probably going to struggle to pick up enough shares to get this down from a 22, say, to a 12 or 13. So if I had to call it, I would say that Apple is still arguably overvalued in this current doom and gloom environment. All right, back to Seeking Alpha to check on Microsoft. Last quarter, good quarter. Beat by 300 million on the top line, beat by a couple cents on the bottom line. This quarter, you've got a 231 right now as consensus, which would be more than last quarter, which is a good sign. Revenue estimate of 52 billion, that would also be slightly higher than the actuals that came in last quarter. But similar to Apple, you see EPS revisions. You got 4 on the upside, you got 15 on the downside. So let's see how that shakes out. All right, let's see how this trend is running for Microsoft. We're looking at fiscal quarter 4 would be the next earnings statement to come out. Similar to Apple, they do not run on the 12-month calendar. You got the consensus right now of $2.30. That would be 6% growth year over year, but the trend is a little stiffer than we saw with Apple, which I think was pretty much flat. Here we see Microsoft at minus 2.5%, and on the 3-month trend, minus 4%. Now, despite all the doom and gloom we've had over the past, call it 90 days, the 1-month trend for future quarters, at least right now, it's still hanging in there. These are all negative numbers, but you notice they also happen to be all negative by less than 1%. So I would call this flat right here. Let's take a look at our revenue for next quarter. And what we have is $52 billion on the consensus estimate. That would actually be growth year over year. Again, you hear a lot of headlines about recession and, of course, the negativity that goes along with it. Microsoft is a company here that is posting double-digit revenue growth, at least anticipated for this first part of 2022, which is also the last part of Microsoft's fiscal year. Now, on the trend line, last 30 days, basically flat. Call it minus 1% on the 3-month, and on the 6-month, still, you put these together and you're basically flat for the revenue growth. So from a consensus viewpoint, staying pretty steady towards another double-digit year for Microsoft on the top line. All right, how does this stack up in terms of forward valuation? Got June 2022. If the consensus holds, it would be $9.30 for the fiscal year that ends on June 2022. That would come in at 16.6% growth on the EPS year over year. Put your forward PE at today at 27.21. That goes for the price of 246 that you see right now. So forward PE of 27.21, that's the number we have to remember. And then on the revenue line, if they get to 198.5 billion, that would lock in 18% growth year over year. And that looks like a forward price to sales just under 10. Back to Yahoo Finance, where does our forward PE of 27 stand in terms of historics? Now, Yahoo has a forward PE of 23. I trust the Seeking Alpha one a little bit more, so I'm going to say it's 27. But if we go pre-COVID, 2019, you're at a 26. 2018, a 24, and then you start to get into the 20s and then the high teens. Microsoft, I think you're going to want to look at it somewhere in this level because of how quickly the cloud changed their entire business dynamics. Not saying the cloud didn't exist here in 16 and 17, but the steamroll or the snowball really started to roll down the hill here in 18 and 19. So if our previous numbers was 27 on a forward PE, then maybe there's a couple more points to to drop off on this price, but I wouldn't go so far as to say that it's overvalued at this point. You just have to keep your eyes open in case they change guidance, because that would obviously impact some of these numbers. All right, how about Google? They last reported on April 26th. They actually missed on the EPS line. If you go to the GAAP actual, they missed by $1, coming in just under $25 per share. Revenue at $68 billion, that actually came in just very slightly higher as a positive surprise. Then if we look ahead to July 28th, which is the estimated release date for their next earnings, you have a GAAP estimate of $26.38. You have a revenue estimate of $70.7 billion. That would also be slightly higher than the last quarter they reported. Our EPS revision trend, very similar, 9 up, 20 down for Google right now, heading into their next earnings call. All right, how's that consensus trend shaking out? Fiscal quarter 2, 2661. That is a negative comp on the quarter. So don't confuse that with the full annual picture. But that would be a negative comp of minus 2.37%. The trend on the projection, basically flat on 1 month. The last 3 months, though, it's gone down minus 4%. You pan out a little bit, it's down minus 2%. Then we look ahead to the forward other quarters, basically flat on the 1 month, but you have been chopped off a few percentage points here on the 3-month trend. All right, how about revenue? Okay, $70.78 billion. That is still, this is top line, not bottom line, that is still almost 15% growth. And the trend on that looks fairly solid. Again, the 3-month has come down probably the most in terms of adjustments. But if we go ahead for the next couple quarters, similar story, 1-month trend, pretty much flat, and then the 3-month takes out a couple percentage points. All right, so how does that roll up into the annual EPS estimate? Google runs a more traditional calendar, 12 months, so they will end on December of 2022. Right now, you've got $112.25 on the EPS line, which is basically flat year over year, 0.04%. So that's going to be interesting. And your forward PE is 1985 if they do, in fact, hit this number. As far as revenue goes, $298.4 billion. That is still solid growth, plus 16%. Forward price to sales under 5. So one of the things that somewhat comparable. So you get the feel, so you get the concept of where things are changing with these companies. You know, the sales for Microsoft and Google, you know, they're still accelerating, plus 16%. But the costs of doing business, or the bottom line, right, the earnings are struggling to grow at the same rate, and that is likely because things are just more expensive to do business here over the past year or so. All right, let's look at Google from a valuation history standpoint. If we go down to forward PE, Yahoo and SeekingAlpha are pretty close to each other. What did we have pre-pandemic, though? That's the question. 24 in 2019. Then you had, looks like, you know, if you put all these together, you were riding in the low 20s, perhaps 22.5 or so if you averaged out these numbers. So not by much, but this 19 or so forward PE does look attractive even if you go back to pre-COVID times in terms of forward valuations. All right, next up we have Amazon, which gets a little clunky because, of course, they just had their stock split. So you see the price 103.8. It's actually down 5% today. But if we go back to April 28th, and SeekingAlpha does the math for you in terms of the stock split, and so does Yahoo too. And under the new share count, that would have been a miss of minus 80 cents. And on the GAAP line, it's basically the same thing. Now, on the revenue side, $116 billion. They missed that by $67 million. How about next quarter? So we have a GAAP EPS estimate of 18 cents. We have a revenue estimate right now of just shy of $120 billion. Very negative though here on EPS revisions. You have one going up and you have 29 analysts or so who have pulled back over the last 90 days. Take a closer look at those revisions for this upcoming quarter. EPS estimate right now stands at 17. Year-over-year growth would actually be down minus 78%. So very negative outlook on Amazon. You can see the 1 month trend, minus 12%. You've got minus 7, 6, 8, 8 over the next several quarters. And the 3 month trend is definitely the lowest out of the stocks we've looked at so far. And the 6 month trend looks to be about the same. Now, I will say, as red as this is, over the past 30 to 90 days, keep in mind that Amazon last year made the strategic decision when earnings were coming in fast and furious to invest back into their business. If you believe in their logistics business and their delivery network like I do, then you could have the counter argument that Amazon is a much longer hold stock, certainly at today's prices, than a short-term play. All right, how about this revenue trend here for the upcoming earnings release? Call it 120 billion. That would actually be single-digit growth, but still growth. Now that trend over the past month has sort of stabilized. Over the last 90 days, though, it is down about 5%, but it's the same story that we saw out of Google and Microsoft. You do have growth on the top line, but it is the EPS, the earnings, the bottom line, that is getting sort of swindled in all of these recession and inflation talks. All right, what does it mean for the fiscal year as a whole? Amazon and Google run a traditional calendar. EPS estimate under the new share count, right? So keep in mind that this is stock split. So we have a new way to look at this. 88 cents per share. Minus 72% growth year over year. Keep in mind all the things I said about how they put money back into their business. That is a forward PE of over 100 at this point, 124. All right, so where does 124 stand in terms of forward PE? And you can see Yahoo has a significantly different number as of right now at 47. I'm sticking with the 124 as the truth. While the 124 sounds high, and it is high from a historical standpoint, there is still an argument in place that the multiple could return to these levels on that 88-cent estimate for the fiscal year. All right, let's take a look at Meta/Facebook, which is officially Meta now. There's no more FB. It's all Meta. In case you can't find anything when you're doing your searches. But we had 427.22 was our last earnings release. EPS beat, GAAP EPS beat by 17 cents. However, the revenue did miss by $300 million, albeit that's on $27.9 billion, so not the biggest miss in the world. Looking ahead to those July earnings, GAAP estimate at 266, that would be slightly lower than the previous quarter. Revenue estimate, though, 29 billion, would be slightly higher than the one we saw last quarter, and the trend remains consistent across all these names. You got 4 analysts calling for outperformance and 19 who have lowered their expectations. Let's take a look at that trend in more detail for this quarter. Right now at 263. That would be minus 27% year over year. The trend over 30 days, call it flat. Over the last 90 days, though, minus 7%. And if you scroll out even further to 6 months, you've had that chopped by 22% for Facebook and Meta. And if you pan out on the 6-month trend, it's actually down minus, call it 23%. Now let's look at the revenue trend for the upcoming release. And you have 29.3 billion. That would be just about flat year over year. 1 month trend, call that flat as well. And it was the 3-month and the 6-month where you really started to see a more bearish view on some of the revenue estimates. And the big thing, of course, on this top line is just struggling to hit that year-over-year growth. And the 1%, call it flat, right, for the revenue, 29.31 billion. But then on the profit line, losing 27% worth of earnings per share. Obviously, when you invest, you hope to see these things step up just a little bit each year. But on a consensus basis anyway, we are not seeing a positive outlook for that to happen right now for Meta. Okay, now how does that all flow into the full fiscal year of December 2022? So the consensus estimate of 1170, unfortunately, the forward PE calculation is a little wrong. Let me run a quick calculation here. So if we are at $168 divided by 11.7, that would give you a forward PE of 1435. So I'm not sure what happened here on these numbers, but 1435 should be the forward PE. Looking at revenue for signs of growth across the fiscal year, actually plus 7%. It looks like this ratio got messed up as well. So $126 billion, if they hit that consensus, they would technically grow plus 7% year over year. Flipping over to Yahoo, I think in this case, we're actually going to use the Yahoo forward PE, which is a little higher than what I calculated. But how does it compare to history? That's the most important thing here. So if we go pre-COVID, you had Facebook. The lowest one was an 18. So you had an 18 in 2018, which, by the way, the market was melting down at that time. If you look at 2019, you're in the 22s, 26, 22, 38. If I just had to do some eyeball averages here, I'd probably say this 22, 23 is going to be your historical average. And with that in mind, sitting today somewhere between my 1435 and Yahoo's 16, I think you could definitely make the argument that Meta is trending below their historical valuation multiple. All right, now I'm going to stop there with those 4 stocks because this video is getting a little bit longer. If you like this kind of thing, I can run it for the Teslas, Nvidias, etc. We can look at that together. We'll see how this video performs. Now, the most interesting thing for me out of this whole exercise is that even though prices have fallen substantially, the EPS changes that have come across these 4 behemoth stocks, right? The way these estimates have been trending down has really made their forward valuation not as huge of a discount as you would think. But if you eliminate Apple from the equation, that is running a little hotter, but has big stock buybacks in their plans, you look at the bottom 3 and you could definitely make some argument for each one of them. The obvious elephant in the room here, though, is just this inflation and how it is impacting earnings per share. And I think that showed up very obviously in the 4 names that we covered, where you had, minus Facebook, you had good revenue growth, but that was coupled with much lower earnings per share in some cases year over year. Now, if you watch the channel a lot, you know that I have low expectations for the market between now and let's just call it back to school time. There's not a lot of positives out there except for one thing, and that is if you still have conviction and a long-term horizon for behemoth companies like these 4, then I just don't see many scenarios over the long term where you aren't making a great investment right here. All right, guys, let me know what was the most interesting thing that you saw in this video today. Always appreciate the comments. Hope everybody's having a great day. Don't forget to check out that Seeking Alpha special offer in the description. We'll see you on the next video.